The current price for Nuburu, trading under the ticker symbol BURU on the NYSE American, is sitting at exactly $0.1964 as of 9:48 a.m. EST on this Friday, January 9th, 2026. We are seeing an intraday drop of about 4.43% right out of the gate this morning. While a lot of the retail crowd is distracted by the daily swings in Tesla stock or checking their Apple stock positions, there is something much more complex and arguably more volatile happening in the world of high-performance blue lasers. Most people look at a stock trading under 20 cents and assume it is just another microcap fading into the background, but the reality is that Nuburu is currently in the middle of a massive structural shift that most investors are completely overlooking. The immediate surprise here is not the price drop, but the fact that the company is effectively trying to buy its way into a completely different sector to stay alive. While the market expects Nuburu to remain a struggling industrial laser manufacturer, the reality is that they are aggressively morphing into an integrated defense and security hub. They are not just making lasers anymore, they are acquiring software firms, drone technology, and mission-critical vehicle companies. This gap between the public perception of a failing penny stock and the reality of a rapid defense tech consolidation is where the real story lies. If you look at the recent price action, it is easy to get discouraged. We have seen the stock hovering near its 52-week low of $0.12, a far cry from the $0.85 highs we saw earlier. But look at the volume. We are seeing millions of shares changing hands daily, far above what you would expect for a company of this size. This suggests some serious positioning is happening. Institutional activity is quiet on the surface, but the recent $23.25 million financing deal with YAIIPN Ltd is the real driver here. This capital injection is intended to fund an acquisition spree that includes Italian laser specialist Lyocon and a controlling stake in Orbit. When you use tools like the Fidelity trading platform or the Robinhood app to look at the order flow, you can see that the volatility is being fueled by a tug-of-war between those fearing massive dilution and those betting on this defense pivot. The tension between expectation and reality is thick here. The market expects the 230 million share offering filed in late December to crush any hope of a price recovery. After all, when a company with a small market cap issues that many shares, the math usually points to a downward spiral. However, the reality is that this capital is the bloodline for their new defense strategy. They are aiming to close multiple deals this month, including a joint venture with Maddox Defense for UAV solutions. If they can successfully consolidate these revenues, the failing laser company narrative might be replaced by a high-growth defense contractor faster than most people realize. When you are doing your own research on investing sites or through individual brokerage accounts, you have to look past the headline numbers. Yes, Nuburu has faced significant financial hurdles. Their current ratio was recently reported at a concerning 0.27, and their short-term obligations have been a heavy weight on their balance sheet. But the recent financing move and the shift toward NATO-aligned supply chains show a management team that knows they cannot survive in the purely industrial space. They are moving into electronic warfare, secure situational awareness, and crisis management systems. This is a high-stakes move. If you are using something like Schwab Intelligent Portfolios or a SoFi Robo-Advisor, you probably won't find BURU on the recommended list because of the risk profile. But for those doing self-investing, this is a classic case of a company attempting a total turnaround in a high-demand sector. Let's talk about what Nuburu actually does for a second, because the technology is actually quite impressive. They specialize in blue laser technology, specifically around the 450 nanometer wavelength. Why does this matter? Well, traditional infrared lasers are often reflected by metals like copper, gold, and aluminum. Blue lasers, however, are absorbed much more efficiently, sometimes up to 10 times better. This allows for faster, cleaner welding and 3D printing of these metals. For years, the expectation was that this would take over the electric vehicle and consumer electronics manufacturing industries. The reality, though, was that scaling this technology for industrial use proved to be more expensive and slower than anticipated. That is why this pivot to defense is so significant. In a military context, the cost-to-performance ratio is viewed differently, and the precision of blue lasers in high-reliability environments becomes a massive asset. The company is now moving towards a dual business model. On one side, they have the hardware, drones, and specialized military vehicles through their partnerships with Maddox and Tekne. On the other, they have the software, specifically the operational resilience and cybersecurity capabilities from Orbit. By integrating these, they are trying to create a full-stack defense platform. This is a huge leap from just selling laser diodes to factories. If you are tracking this on the Robinhood trading interface or checking your Fidelity brokerage account, you need to be watching the January milestone very closely. The formalization of the Tekne partnership and the closing of the Lyocon deal are the next big hurdles. One thing that often gets missed in these small-cap discussions is the importance of the trading environment. Whether you are using Interactive Brokers Trading or the SoFi trading platform, you've probably noticed that liquidity can be a double-edged sword. For Nuburu, the high volume we have seen lately means you can get in and out of positions, but it also means the price can swing 10% or 20% on a single piece of news. We saw this in early January when the stock jumped over 25% on news of the new financing. The expectation was that the company was out of cash. The reality of a $25 million backstop caught the shorts off guard. If you are looking for investment help or exploring online investing options, you have to ask yourself if you believe in the management's ability to execute this consolidation. Alessandro Zamboni and the team are betting the entire company on this defense tech hub concept. It's a bold move, especially while trying to maintain compliance with NYSE American listing standards. They recently restored compliance, which removed a major delisting risk that had been hanging over the stock like a dark cloud. That was a moment where reality exceeded the bearish expectations of the market. Before we go further, I want to hear from you. Comment below how many shares of BURU you currently hold, or if you are waiting for the next dip before you even consider entering a position. Do you think the pivot to defense is enough to save the company, or is the dilution just too much to overcome? I read through the comments to see what the community is thinking, especially on these high volatility plays. Now, looking at the macroeconomic pressures, Nuburu is operating in an environment where defense spending is at an all-time high. Allied and NATO countries are looking for exactly the kind of sovereign technology that Nuburu is trying to build through its European acquisitions. This isn't just about selling a product, it's about being part of a secure supply chain. This is why the acquisition of Italian firm Lyocon is so important. It gives them a manufacturing beachhead in the EU. Most investors using Robinhood Crypto or checking their SoFi ETFs might not be looking at Italian laser engineering firms, but that is exactly where the value is being built here. The risks, however, are very real. When you look at your interactive broker's fees or your individual brokerage statements, you have to account for the possibility that these acquisitions don't integrate well. Consolidation is hard. Managing a team of 8 people and then trying to run a multinational defense hub is a massive scaling challenge. The expectation is that they will create synergies. The reality could be a messy integration that burns through their newly acquired cash. Furthermore, the 230 million shares that could be sold into the market by NYSEAMERICAN Ltd. represent a massive supply of stock that could cap any significant rallies. If you are the type of investor who prefers the safety of Fidelity mutual funds or Fidelity IRAs, this level of risk might be outside your comfort zone. But for those who use the Robinhood app for active trading, the setup here is undeniably interesting. Let's re-examine the business model one more time. The blue laser segment is being revamped to focus on dual-use applications. This means the same technology that can weld a battery for an electric vehicle can also be used in directed energy applications or for specialized additive manufacturing on the battlefield. This move away from being a purely industrial company is a strategic necessity. The market for industrial lasers is crowded and has thin margins. The defense and security market, while harder to enter, offers much more stable long-term contracts. This is the reality that Nuburu is chasing. In the future, we could see Nuburu becoming a name that is mentioned in the same breath as other defense tech upstarts. But for now, it remains a high-risk, high-reward bet on a total corporate transformation. The gap between what the company was and what it is trying to become is where the opportunity and the danger reside. Investors should be watching for the official closing of the Lyocon deal and the first revenue figures from the integrated defense platform. If they can show even a small amount of traction, say the $500,000 in initial billings they were targeting for late 2025, it could start to validate the entire strategy. To wrap this up, the situation with Nuburu is a classic study in the tension between a company's past and its potential. The expectation is that BURU is a penny stock destined to stay in the sub-20-cent range due to financial instability and dilution. The reality we are seeing is a company that has secured significant